Hi there, a very good morning and good afternoon to all of you, depending on wherever you're hearing me and watching me. This is Simply Stocks, and I'm live in this live session with you all on YouTube on this Sunday afternoon, slightly late. Apologies for that. There were a lot of things I was trying to maneuver at home and do something with. So there were some issues, so got them resolved. So I'm live, and today I'm going to talk about a very interesting fact. Although uh, it is said then and it is realized that whenever the markets, whenever there are interest rate hikes, then markets fall or markets will be jittery. But the history tells us a completely different story, and so we'll discuss about those things. Plus, we'll answer your queries. So hopefully, more people would join in. Sayed Tariq, Assalamu alaikum. Hi. Uh, and hopefully, more people will join in as it's a Sunday afternoon. A very good afternoon to you, Anirudh. Uh, and so we'll begin the session in earnest. It was a very interesting last 2 3 days, I mean, in the markets, and uh, things are pretty different. So uh, first the market fell 800 points, next day the market has gone up 400 points, and there is a chance that after what has happened with the Dow that has reclaimed 34,000, we could be looking at 17,000 on the Nifty by tomorrow. So whatever fall that we saw from 17,080 all the way to 6150, sorry, 16,150, it's going to be reclaimed, and this is a very bullish sign for a market that had gone down some 5% in a day. Normally, this kind of you can say recovery do not happen in market, but this is a complete reversal in a day or two of what happened just 2 days before. So quite interesting, and the same kind of things happened in 2020 when the market fell sharply and recovered within a year. So within a few months, the market was up 30 40% from those lows. So it's kind of interesting and very interesting times in the market. It's very new for me as well, being in the market for the last 10 years, the way the markets have behaved. Uh, Probably because of the way DIIs have got into the mix, and the way they are buying. That could be one of the reasons. So, as far as markets are concerned, and you want my opinion on that, I believe that the worst probably is over, because the worst that the world feared was a war, and that is just not happening at the moment. I mean, a world war kind of a thing, or a thing that everybody gets involved and all, that is not happening, at least. Although it is very sad at whatever that is happening in Ukraine, and hope that also subsides quickly. But it's not escalating. So based on that fact, what investors are analyzing is that the crude may not go beyond 105 $107 per barrel. uh, right now it is well below $100 per barrel, and in the worst scenario whatsoever, what has happened is, in some other way, it has helped the equity markets, because the Fed may not hike rates at 50 to 75 basis points, and may just hike rate by 25 basis points. So that is two things out of the way. Plus there were margin, you can say, new norms on margins for intraday traders and all, FNO, etc. That has been delayed by about 2 3 months, so that has been a positive. So a lot of negatives that I recounted uh, probably in the last live session has subsided over the last 2 3 days. So it's kind of interesting times. At 17,000, I won't say that we are very gung ho on the market. At 16,100, I was not saying that go ahead and buy. So it's kind of confusing for all as to how to go about navigating through the markets. What I can tell you is that if you are not into the market big time, if you are not analyzing companies and being, see, with the market every hour, invest or get into stocks. Even if you want to do positional trades, get into stocks which are large in nature, say a Reliance, TCS, etc. uh, if you can weather the storm, because there will be a lot of volatility in March, next 1 month at least. We are going to see a lot of volatility. I won't be surprised if we test 16,200 again and then go up again. So a lot of volatility awaits us over the next 4 weeks. uh, Basically speaking, personally speaking, I'm ready for that. And that's why I have taken positions. I have disclosed that, and I may take positions more on by Tuesday, Monday or Tuesday, and will be fully invested again. But for you, if you can't take that 5-7% nifty fall over this 1 month and then a recovery and all those kinds of volatility, then stay away from the market. Probably invest after the 20th. If you can take that and you want to trade into the market, you can definitely buy, but be ready to see a drawdown of 10-15% on your buying levels in this period, and probably a recovery. So what I'm banking on is the fact that the rates that would be hiked by the Fed would be around 25 basis points. uh, because the oil has not, you can say, surged, and it's around 92-94 dollars per barrel, although it is at least 20% higher from where it was last time around, when continuous hikes of oil prices happened. We could be fine. We won't be in a very bad shape, say 1-2 months down the line. Yes, there will be oil price hikes post the election results and all. And then what is the elephant in the house right now? I think that is probably uh, the election results of UP that would come out by the 10th of March. uh, I feel that at that point of time, that's my assessment, that if at that point of time the markets are around 17,000 to 17,300, in this range, we could, if the results are not favorable, we could see a decent, you can say, pullback, and then a buying, then you can say a recovery with a lot of buying at 16,400, 16,200, between those levels. So that is how the markets would be in the next 2 weeks. I am investing fully because I believe that the lowest point for the market has been touched. I think 16,000 will remain a very good support. 15,700 to 16,100 is a strong support. If you go back in time and check the last 1.5 years Nifty levels, you'll be able to understand that between 15,700 to 16,100 has been extremely good support. So as far as the markets are concerned, in my opinion, because of a, you can say, such a geopolitical situation, I believe that 16,100 could remain as a low for the next foreseeable future, unless a rate hike of more than 50 basis point or 50 basis point with an hawkish commentary, etc., take place. And then there is a, you can say, uh, see the party that would come in, and the markets would like it if the results are completely reverse and both things happen simultaneously, then you may see by the 25th of March below 16,000 levels. But again, there, I think there will be heavy buying at 15,700, 600. So most likely the market could end up being in a range of 17,600 to 17,000 levels, and hence I'll be buying on a gap up tomorrow, rather than probably worrying and looking at levels of 16,000 coming in a week, 10 days down the line. So there's a better probability of seeing the market higher, because a lot of problems that awaited us has subsided. And apart from that, the biggest issue has been the interest rate hike that will happen in India, that I was talking about. I have done some research on it, and we'll discuss about that now. All right. So as far as the interest rate hikes are concerned, and I've gone through some of the text of the past, I'm not saying exact numbers here, but just to tell you that in 2000, between 2004 to 2008, there was a nearly a 4% or 400 basis points interest rate hikes during that period, and the market went up on a CAGR basis close to 23% CAGR. So every year 23%. Between 2008 and 2011, we had interest rate hikes, at least till around early part of 2012. I think it was till March, April, May. We have interest rate hikes which was close to around 3.5%. I think from 5.5 to 8.5%, something like that. Uh, and the market on a CAGR basis again went up by nearly 19. 18-19% CAGR. And then between 2016, early part of 2000, mid 2016, till you can say 2020, around, sorry, 2018, over this 2 year period, there was around 4%, 3 to 4% interest rate hike from the lowest level to the highest level. And again, the market went up on a CAGR basis at early teens, I think 14, 15%, 13, 14%, something like that. uh, and one thing I want to remind you of, at least for 2016, because I have been in the market since December of 2011. So, two periods of interest rate hikes I have seen already, even in 2011. So, I remember before the hikes started, that was, sorry, before the hikes ended, that was 2011 December. And between 2000 and say from 2009 March till 2010 November, 2009 March till 2010 November, we saw a huge rally with interest rate hikes and everything that was happening. So it was all about valuations. At 2300, everything was extremely dirt cheap. So there was heavy buying, irrespective of what was happening in the macroeconomy. And from 2011 to 2014, the returns were not that great. Okay. But still, the market in 2011, December, I remember it was around 4,400, and people were talking of 3,500 and even 2,500. But from 4,400 till 2014, till the interest rate hike continued at the end of 2014, we saw with the government change and everything, 6,500 or something like that, there was a 2,000 points rally. So again, over that 3 year period, we had around a 60%, 55, 60% rally, around 55% or so. That is around 14, 15% CAGR. So what I'm trying to say here is that, and then the third point. So in these two occasions, if you understand, the market priced in those hikes very early, extremely early. So in that 2008 to 11 period, in 2009 February, the market fell a lot, so over that period. But by 2011, when the hikes ended, we were up substantially. And again, when hikes started in 2012 or so, and all those periods, again, we had the time that where the market probably declined in 2011 November December, and yet went up after that. So in both cases, what happened was market priced in the interest rate hikes very early. The fall in 2008-9 priced in the interest rate hikes till 2012. The fall in 2011 December priced in the hikes that were to take place till 2014. And coming to the third occasion, where I clearly remember what happened, was that the interest rate hikes happened or started in 2016 March, April, ended in 2018 April, and the market already fell a lot in 2016 February. So basically, the point was, so as I mentioned earlier, that market fall a lot, 22%. It was the fall between 2015 December to 2016 February. That's why I came out with a point that we could go down to 15,000 levels if this tensions in Europe escalate, and we have a very negative verdict in the election. So all things coming together, we could see 15,000 very early. But since the market has reversed from 16,100, because it could have been an easy situation that, okay, yes, the tensions in Europe is fine, but there will be a lot of oil price hike, there will be interest rate hike and all. The market would have continued to gone down here in India after opening gap up, and we could have gone to 15,300 odd levels and then recovered. Since the market reversed post just the one announcement, I am a firm believer at looking at prices. Uh, I feel at 16,000, a lot of interest rate hikes, not in US, I'm talking of India, has been priced in, because in US, the problem has always been there and they will continue to raise hike. But in India, the rate hikes will take place from June onwards. So at 16,100, especially after the move that we'll see, and we'll see a gap up opening tomorrow, I think at 16,100, those hikes are priced in. Yes, 100 200 point here and there we can go down, we could touch those levels again, we could retrace back to those levels, but we'll have a strong bounce back from there. So basically, what I want to say is that Mr. Market is always very efficient and they know about the market more than what we do. So no matter how much halabaloo we do with the fact that going forward the earnings of companies will be less, interest rate hike will be there, so a lot of cost on the bottom line would come in and profits will shrink and this and that. So in at 16,000, even if the numbers are around 830 rupees, people were pricing in 850, 860 rupees for FY23. If it is 830 rupees, 730 rupees is this year's EPS, say a 15% increase on this. Remember, this year in FY22, also we have had very difficult period of the June quarter, very difficult period of the December quarter. So it is not that sorry, September to December and all those kind of periods, because of spike in the pandemic cases and all. So it is not that this has been a smooth sailing year. So there has to be some appreciation on the numbers, even with the hikes in rates in FY23. I believe it would be around 14-15%. I think 820, let's say even 820 people were pricing in 850 rupees. At 820 rupees, at 20 times, we are looking at 16,400. And at 19 and a half times, it was 16,100. That's what where the market went, touched and came back. So 1 year forward earnings at 16,150 is around 19 and a half times it is trading at. So basically speaking, in a nutshell, at 16,000, the market is extremely cheap, especially after a 20% fall in the small cap index and 22-23% fall in the mid cap index. So everything has gone down very sharply, and that's why the recovery. Yes, there will be corrections, but now things will change. So before, what was happening in the last 4 months is that there were lower highs and lower lows being made. Now things will change, that's my assessment. So this is the time to get in, probably tomorrow or on slight decline little bit, but be ready for volatility over the next couple of months or so. Why markets go up on interest rate hikes? My assessment is that most markets globally have top-notch companies in the Nifty, say in their main indices, say a Nifty or a Dow Jones or a FTSE or a DAX or CAC or the Shanghai Index or the Nikkei or the Kospi, you name it, across the world, where Korea, Japan, etc. They have the other Taiwanese index and all. They have the best of the best companies in their main indices. So what happens? These companies are virtually debt free, so there is hardly any effect of the interest rate fluctuations that take place. Or if they are having debt, they come into their main indices because they have reduced debt over a period of time. And what has happened in India, especially in banks and financial institutions and many other companies, that a lot of you can say debt has been reduced by companies, especially after 2016 16 17 or so. So after that, you can say fall we had in FY18, from FY18 to FY20, we saw a lot of you can say debt being reduced by the company, especially with the way the pandemic hit everyone. So debt got reduced sharply, even in real estate companies, infrastructure, capital good companies. So there will be effect of interest rates. I'm not saying there won't be, but the market is pricing in early. So you see, you look at the Nifty, you can say the reality index, you look at all the capital goods companies, you look at many other companies in which there is high interest rate cost, textile companies, you look at a Wellspun India, look at a lot of textile companies that have already gone down a lot. Now to think that okay, now interest rates will go up, numbers will not be there, stock will fall a lot. So what will happen is, since the market have priced that in, the stocks will be relatively not about 20% lower, 30% lower from their 52-week high. And when the results come in, the worst of the results with these interest rate hikes, these stocks will sharply go up. That's what we saw with Lotus Labs, that when the management said that this was one of the worst quarters and things will improve going forward, we had 460 on the stock, 450, and now we are at 530, 540. So overall speaking, everything gets priced in early, and we as retail investors tend to react late, and so what happens is we miss out on the biggest rallies that take place. So probably it's time to navigate through the stocks and find out which are the stocks that could come out with very decent numbers in the June quarter, not in the March quarter, but in June quarter and September quarter, and build positions. Likewise, considering if you are having a short term, you can say investment position, say 4 to 6 months. For long term investors as well, wait for declines. Don't buy now, wait for declines to 16,500, wait for declines to say 16,600 levels, and then buy into it. Any declines in your major stocks, say a Reliance at these levels, or any other stocks of that nature, you should buy on major declines and all. So in that regard, it's time to probably buy and buy incrementally. If you have a 2 3 year time horizon, you'll get opportunities, you'll get declines, etc. If you have a trading interest and if you want to buy for the next 2 3 months, I think this is the best time to buy. You have seen the lows. You have, say, I remember most of my patron members, if they would have acted on what we discussed 3 4 days back, we would have gained a lot by missing out on that downfall that we saw on Friday, on Thursday, Friday, and all those things. So most probably, sorry, on a Monday, Tuesday, whatever it was, when the market fell sharply, I think it was 24th or 25th. Uh, so basically speaking, 16,000 for me is somewhat of a bottom at the moment. I was waiting for 15,000, but that did not quite what happened or culminate into. All right. So I'm ready to answer your queries. Kindly use the super chat and super sticker feature that will help me grow the channel. That help you also ask me questions and ink out answers in greater detail. My view on HUL, do you see more downside? I think HUL is in a very safe zone to buy. Probably 2000 is a very strong support. There could be a 3 4% more downside. I think HUL, Nestle, etc. These are good stocks to buy in this kind of an environment, from a 2 3 months point of view. And then probably when things stabilize globally and here in India and everything has panned out, then we could definitely look at small and mid cap companies. ADF Foods looks extremely interesting now. And in fact, I was looking at their numbers now. It is trading at somewhere around 1.2, 1.1 times sales. Very interestingly poised. I think it's a long term bet, long term multi bagger. I still believe ADF Foods can be. See, Tube Investments is a good 3 year play. It's not something that you can trade on. Yes, at these levels, one can buy, have a 3 year view, should perform well. Sona Comstar, see, I think you are asking about Sona BLW, if I'm not wrong. I would say it's expensive, but I don't know whether. See, I have not done complete research on the stock, but looking prima facie on the numbers, it looks slightly stretched. So that's the call there. Looks good. Infosys. Somewhere I feel that what you need to do. So Infosys, TCS, Tech Mahindra, Tata Elxsi, these are very good companies to invest for the next 3 4 years. For trading, I would say that you wait for a couple of quarters. After 6 months, I think you'll get better prices on most of the mid cap and large cap ITs, and there will be a very good run, I think, after 1 or 2 quarters. So for trading purposes, for investing for short term, I think it's better to buy on major declines later on, say in 6 months time. For investment, I think these are good levels to buy, even in LTTS or LNT Infotech, etc. I won't say get into HDFC or HDFC Bank. See, interest rate hikes mean a lot for companies which have high debt. It's as simple as that. It's not a complicated thing. So buy into companies which don't have debt. It's as simple as that. And there are many companies which either have working capital debt or don't have any debt whatsoever. Not just in consumer staples or FMCG, there are many in many segments. For example, Kilpist has virtually no debt. Again, a disclaimer, I have the stock. Many small cap companies do not have debt, and small caps have come down a lot. Many mid cap companies do not have debt, and they have been battered out of shape. So you look at those 40-50,000 crore market cap companies, 30 to 50,000 crore market cap company. You'll find many which are down 20 to 30%, but are doing well and would not be affected if there is a sharp interest rate hike. In fact, people or investors would try to get into those stocks because they don't have any debt. Thanks a lot, Rohit, for your contribution. Thanks. And if you have any query, you can shoot that to me. Okay. So HDFC, I think life insurance should do well. The only issue with that has been the pandemic in the last 2 years. So they would have to give away a lot of funds, claims on claims, etc. I think you wait to couple of quarters and they will start doing well again. All see HDFC Life is the top pick there. Uh, and it has to be a 7, 8, 10 year investment. It cannot be you can say a short term investment in that regard. Okay. See, TTK Prestige looks interesting, very interesting at these levels. It accumulates slowly from a long-term point of view. Again, not tradable, but a good investment. It can be. It can produce a 20% CAGR over the next 4 5 years for you. Definitely. I have not done research on Godrej Agrovet, so won't be able to comment on that. See, route mobile, I won't not prefer. Remember what I said just at the beginning of this presentation or this live session. Look into companies which are producing good results and are expected to produce very good results. When you look at something like a route mobile, it has been producing very shallow margins and you can say profitability growth. So that's why it has got down to such a level from the top. So see, the best way to look at these stocks is that you look at numbers, and if numbers are not improving, don't buy the stock. And if you get opportunity, sell at little loss, say 10%, 15%, and that's just about it. And get into winners, whichever companies that are producing very good numbers and are expected to come out with good numbers. Okay. I've not done research on hemisphere properties, but what I can say on real estate is that Macrotech is good, Shobha Developers is good, Prestige Estate, Brigade. All these companies are pretty good to buy in this move. And I think real estate, those companies which have extremely low debt, will continue to perform well. Real estate sector has been bruised and battered again in over the last 3 4 months. I think it's going to come back as well, pretty well. See, camps again. See what Pradeep, what I can say is that look at companies which are either making new highs or are doing well in terms of stock price. Camps has been relentlessly going down. I've seen the numbers. Numbers are okay, but the way the stock has gone down, I won't like to touch that stock. I mean, don't look at after a fall. Look at companies. I mean, don't look at companies which have fallen 40 50% and the numbers are not that great. If the numbers are good and the stock has fallen, then you can probably buy. So it's a complicated situation at the moment. I would say the best thing to do for most investors, most retail players, even for trading, is to buy into larger companies, larger than 50 60,000 crores. I would say avoid ABB India. I won't say it's a buy at these levels. I mean, all these capital good companies. So, Prasad, thanks for your contribution. See, Precision Wires is a good company, but auto ancillaries and such kind of manufacturing firms, I would stay away with. You need to look at debt. If the company has very low debt, yes, you can accumulate. But again, look at larger companies to buy into. That would be my preference rather than getting into small caps in a big manner. So Repro India, long-term story is intact, but short-term it looks under pressure. Sequent a disclaimer, I have the stock. I feel over the next 6 months, it could go to 175, 180 from here. It's at 135. I think there could be a 30% move in Sequent, but only buy if you have it, then hold. Don't buy fresh. That's my call on Sequent. All right, guys. Thank you. Thanks a lot for being online, and please like and subscribe my channel and hit the bell icon so you can get my videos straight away when I post it. And kindly do support me on Patreon. Thank you.